My name is Kerwin Phillip. I'm author, speaker, financial literacy advocate, author of several books. My latest book, this one here is called The Interview Playbook, Teens Guide to Landing the Job. ABC's a financial literacy coloring book. Got the Money Twins, Nichole and I Learn About Payment Methods, and the flagship book, Malik's First Job, Financial Principles for Teens. But this evening, we're going to speak about something specific. We're going to speak about credit basics for teens and young adults. And we have a special guest coming this evening, Miss Nichole Milton. She's a commercial and residential real estate agent out of New Jersey. And we're waiting for her to join on. And I think I see her here.
There we go.
There you go.
Are
Hey,
you able
what's
to
going on?
hear me? I'm doing good. How are you?
Good. Thank you for joining me this evening and
Yes.
to share your insight on such an important topic
Yes, it
as it
is,
relates to
especially for
our.
young adults.
Yes, ma'am. So, for those who don't know who you are, go ahead and introduce yourself. Let the people who know who you are and what you do.
So my name is Nichole Milton. I am from New Jersey. I am a commercial and residential realtor.
Hmm.
Um, I am 33 and I've been a lifelong resident of New Jersey.
No doubt, no doubt. Well, now, what part of Jersey?
North Jersey, Jersey City.
Oh, JC.
Yes.
JC is in the house.
Yes. Close to the city, but we're not on the other side of the Hudson.
Yeah, that's what's up. That's what's up. So again, I know in your line of work, you come across a lot of folks, a lot of different credit scenarios as people are trying to purchase their homes and dibble and dabble in the real estate space. So I know you're like an expert in this particular field, and I think your video is clocking right now. It's let's see.
I was just about to message. I was like, I got kicked out.
Yeah, you had froze up for a second.
I was
So
like, I don't know what happened.
yeah. But I was saying that I know, like in your line of work, you come across a lot of different credit scenarios. So I know you're an expert in this particular lane.
Yes, we deal with various types of credit scores, ranging from no credit, bad credit to extremely
Hmm.
good credit.
Right,
But I know you wanted to focus like more so on the teens, but in general, credit is extremely important.
right,
I know, like for myself in particular, growing up, no one talked to us about credit, which is,
right.
I think, really weird and should be talked about a lot more often.
Yeah.
Um, you need credit for everything. You need credit to, I mean, jobs look at your credit score nowadays.
Hmm.
Cell phone providers look at your credit score. Um, I know New Jersey, our electric provider, PSE&G, even looks at your credit score. So
Right,
everyone is looking at your credit score to even see if they want to open an account with you, to see how you're handling your finances, how you're paying back your debt. So it's extremely important that you take care of your credit. And for young adults, if they're not even sure what their credit score is, they can compare it to like their GPA. Their
right,
GPA would be equivalent to like their credit score, just way more important depending on what field they want to go in. But they kind of go hand in hand.
right. So when we talk about credit score, can you kind of elaborate a little bit more exactly what a credit score is?
So your credit score is basically a number that represents how you repay your debts to your lenders. It shows that you borrow money from, like, let's just say, a bank, and you
Right,
repay that back every month on time. On time. You're making monthly payments on a set schedule, and you're never ever missing a payment. Whether it's one loan, two loans, 10 credit cards,
right,
two-car loans, no matter what it is, you're always paying back your debt on time in a timely fashion. You never miss a payment. As long as you never miss a payment, your credit score is going to continue to rise because your payment history is the
mhm,
biggest factor in your credit score. Other things affect your credit score, like how many credit cards you have open, the length of your credit accounts. Those things play a factor, but the biggest factor is your payment history.
right, right. So as a team, trying to get their grips on all this information, what would be the best way for them to kind of build their credit?
To start off, if they have either their parent or guardian that
Hmm.
they trust and know has good credit, they can be added on as a authorized user on a credit card.
Okay.
If they don't have that, it would they would kind of have to wait till they're old enough to sign up for their own credit card, and then they can do like one of those credit builder accounts. I know
Okay.
like Capital One, PNC, a lot of the major banks has them. One that I really like is Chime. Chime offers to do like a secured type of card where you
Okay.
can put money into it, and the money that you put onto it is the money that you use. So if you load $100, then you have $100 to use, but that $100 is reported to the credit bureaus
Right.
as your credit card, and you cannot overdraft because you only put $100 on it. So you are
Right.
never be in an event, you'll never be in a predicament where you wouldn't make the payment on time. So it helps you to build your credit score.
Right. And I think I heard like several banks do that as well. You
Yes, the
know that.
difference between the two is with the major banks, you have to give more like, I would call it more like a security deposit because they
Yeah.
want a lump sum up front. So they want like 400 or $500 up front, and they hold it the entire time the card is open. And then you
Right.
pay back, like you use it, it's almost, they use it more like a traditional credit card.
Hmm.
Whereas with Chime on a monthly basis, like say today I put $100 on it, I can use that 100. And then tomorrow I can put another 200, and then I have 200 to use. So I can manage what I want to use, but whatever it totals to at the end of the month, that's what's reported to the credit bureau versus just a lump sum that I'm using like a traditional credit card.
Wow. Wow. Okay. So so you often hear people say that as they're trying to establish their credit or try to build their credit up, that they should carry a balance on their credit cards. Is that true? That is to help build your credit up, you need to carry a balance from month to month.
Not necessarily. It's not bad if you carry a balance. Most companies would prefer that you keep the balance on your cards on average, keep it to 30%. It would be better if it's under 10%.
Okay.
The lower the balance, the better because it keeps your utilization lower. But it's not a bad thing if you do carry a balance. It's just your debt to income like ratio and
Hmm.
what your overall utilization is. So if your credit limit is $1,000 and you're maxing it out every month,
Yeah.
that doesn't look good to the lenders. But then you're not
Okay.
paying back that $1,000 every month. Versus if your limit is 1,000 and your balance is only $300, it shows that you're keeping a low balance on the card.
Right.
I always suggest paying it off as if you can,
Hmm.
or keeping that balance as low as possible because you don't want to keep it at zero. Because then if you keep it at zero, then it shows that you're not even really using the card,
Right.
and that doesn't really help you either because you need to show some activity on the credit card.
Right.
So if you use it to get some gas and then pay it off. Or what I usually recommend is if you have like the monthly subscriptions, we all have them. Netflix, Hulu. At this
Hmm.
point, everyone has all the
Yeah.
major. You can't
Right.
avoid it. We got rid of cable and switched over to all of these little subscriptions. Put
Right.
those on the credit cards and then just pay those off every month.
Okay. That's a good strategy. Now you speak about utilization. Does that impact your credit score as well?
Yes, the higher your utilization, the lower your score would be if over a long period of time because you're carrying that balance month to month. You
Okay.
want to kind of keep that as low as possible. Like I said, 30% is what most people will tell you. If you can get it down to 10, that would be better because it shows that you're keeping that balance lower and you're paying it back.
Okay. 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 Now, you speak about paying the balance every month. Now, can you explain to the audience like what's the difference between the statement date and the due date on the card?
Yeah. So the statement date is the end of your credit card. So every month you'll get a credit card statement. Usually it's a monthly rolling date. So let's just say August 1st to August 31st. It's usually August 30th is a 30-day rolling period. Then at the end of August 30th, they'll tell you that your due date to make your minimum payment will be, let's say hypothetically, September 7th.
Okay.
Theoretically, you would want to pay down, let's go back to that $1,000 credit card limit. If you maxed out your credit card to $1,000, you'll want to bring down that balance to at least 30%
Okay.
or 10% by August 30th, at least a few days before. Because when you make a payment, it does take a few days to clear. So you
Yeah.
want to try to make the payment at least, let's say, 5 days before, so that by the close of August 30th, your balance that's going to report to the credit bureaus, which is the close of your credit card statement, is going to
Hmm.
show a 10% or 30% balance on the card. Versus if you make your payment on the statement date, you're still going to be in good state and it's good standing, whether you make
Right.
the payment on the 30th, August 30th, or September 7th. The difference would be whether you pay the balance in full on September 7th. Because if you just make the minimum payment, now you're going to accrue interest on the remaining balance versus
Right.
paying everything off. And you're going to
Yeah.
show a higher carrying balance month to month by not paying the full balance off.
Okay. Okay. That makes sense. That makes sense. Now you mentioned interest, right? Now, how important is it to pay attention to the interest that you're paying on your credit cards? 'Cause I know depending upon your credit score, the interest rate that you pay on the money that you borrow can fluctuate. Can you kind of
Yes.
build on that a little bit?
Yeah. So every month, like I said, the $1,000, if you paid usually the minimum for credit cards, I would say averages about $25 to $35 is your minimum payment that's required.
Right.
So if you maxed it out, your balance remaining would be like $975. You're now going to pay interest on that. And interest rates right now are extremely high. On
Right.
average, the credit card interest rates are like 25%. So
Hmm.
now your next statement is going to have your interest accrued on that balance. Now you're going to go over your credit card limit because they're going to add 25% interest on that $975 balance. Now
Right.
you've exceeded your $1,000 limit, which doesn't look good to the credit lenders and the banks because now they're saying you're overusing your what you've borrowed on the credit card
Right.
because now you're not paying it down. Now you're over that $1,000, which is why you should try to keep your balance under the $1,000 limit, or like I said, 10 to 30% of that. Because then over time, you're never going to get that. Not that you're never, I should correct myself. It's going to take you longer to pay down the credit card by only paying the minimum balance because you're
Yeah.
constantly accruing interest on top of interest every month.
Right. Right. So, um, so looking at again with the interest rates and things of that sort, um, what's like a good best practice? Like I know oftentimes kids, or I remember when I was in college, we had those different banks, that was out there trying to solicit, trying to get us to get credit cards. You know, what's the best approach to like getting all these different credit card offers? How do how should teens handle those type of scenarios?
I would say try to stick with the secured cards if you could, if you have the
Okay.
ability to give the lump sum or do like the chime. That way
Hmm.
your limits are lower to start with and something that's more manageable.
Right.
Because I was a victim of those two. The went to college and they were
Right.
like, oh, sign up for this, sign up for that. And no one tells you what you're signing up for.
Right.
You're
You
just
just
like,
will
oh,
get the
now I
free
have a
umbrella.
card. Like, free umbrella, you get a gift card. You're like, oh, this is great. And now I have a credit card to spend more money on, not realizing that I have to pay this back. And as a
Yeah.
college student, you're like, I'm not working.
True. That's
How
true.
am I giving this? How am I paying this back? And then you start calling your parents. Then,
Right.
so it's like if you can, because some college students do work. If you can try to do like the secure cards.
Hmm.
I know banks like Capital One, I believe Chase, sometimes will start you off with like a lower credit limit,
Yeah.
usually around 750 or 1,000 if you're newer.
Yeah.
If you get added on as an authorized user to someone and they give you all of that back history, your limit will probably be a lot higher.
Yeah.
Um, I would say try to manage it as much as possible because you don't, once you see that availability, it's really kind of hard to not swipe your card.
Right.
It's hard, especially at that age. It's like, okay, I don't have, $300, but I have the credit card. Let me just, let me swipe the
Yeah.
credit card. And then next thing you know, that statement is hits your email
Yeah.
and you're like, oh, what am I going to do? And
Yeah.
then you start paying the minimum balance, and now we get into the cycle of we're just paying the minimum, paying the minimum, paying the minimum, and we're in this thing where we're in a credit card debt that a lot of people get into.
Right.
And then you add on student loans on top of that because now you start taking out student loans, and it becomes a snowball effect
Yeah.
of a rolling debt that we struggle to get out of.
True.
So if you
True.
can kind of try to keep your credit card limits lower in the beginning, especially while you're in college, that to me that's more beneficial.
Yeah. Yeah. So would you say that's like the biggest mistake young people make when it comes to credit? the whole overspending or getting caught up in that.
I think it is.
Yeah.
I know that was something that I definitely spoke to my siblings about.
Hmm.
Because I was the first of my siblings to go to college, and no one talks to me about like what student loans were, how they would affect me, credit card debt.
Right.
So when I graduated, I actually had suggested for I'm the oldest of 14. So when my sister after me went to college, I was like, hey, I think it's better if you go to a 2-year college because
Hmm.
you're going to do those general education classes that all of us are required to do, whether you go to a 4-year college or a 2-year college. It doesn't make a difference. We have to do
Yeah.
those same, classes. And in the long run, she saved thousands in student loans and thousands in debt versus what I did if I had the same advice.
Right. 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 So, so let's say a young person, went through this process, got the credit cards, and they find themselves, really caught up in the web of credit card debt. What are some ways they can kind of get out of it?
I would say talk to your lenders, see if they can freeze the cards or stop any available usage on the cards until you can pay them down. Some of them will work with you where
Right.
they'll give you like a forbearance for like a year where you just put the money towards the card. Or sometimes you just have to get really aggressive and start putting more than the minimum payment on the card to start paying it down. Because the
Yeah.
interest is what's going to kill you every month.
True.
And if you're only putting $25, but you're accruing, say, $30 or $40 in interest every month, you're never really attacking that actual principal balance of what was owed. It's going to take you forever to pay it down.
Right.
So instead of putting 25, you may have to put 100 or 125 to really start attacking that balance.
Right.
And keep doing that. And once you pay off one card, take that same money and put it towards the next one.
Right. Right. I think they call that the snowball effect, I think it is, or
Yes.
the
Yeah. So
snowball
if you were
method.
putting like 200 towards one and 50 towards the other one, and you paid off the 250, take that 250 and keep applying it until everything is paid off.
Right, right.
Yep.
So for those watching, if you budgeted a certain amount of money towards a credit card bill, you got one card paid off, don't take the extra money and go buy some new Jordans or buy some new shoes or buy a purse. Take that money and apply it to the next card and get that taken care of and get yourself out of debt. Right?
Yeah. Another thing I also recommend is having two separate accounts. Have an
Okay.
account that your bills come out of, every bill,
Right.
whether it's your rent, your subscriptions, books, whatever you have to pay for, a spending account and then have an account that is solely for you. So that
Right.
the funds aren't intermingled. Because sometimes that's usually what happens when you don't realize, oh, I needed to pay X, Y, and Z, and you thought the funds were there, and then
Right.
you went and got, like you said, some new Jordans. You went to Starbucks, and then your account's overdrawn.
Yep.
Separate the two.
Yep. Yep. I think that happens to me sometimes as well. You'd be like, wait, I got this extra $200 in the account. So okay. Then after you done spent it, you're like, oh, that's supposed to go towards the that
Especially when
bill.
it's pending over the weekend, and then the pendings drop for some reason, and then they give you back the money and then take it out.
Yep.
Separate the two.
Amazon. I'm not saying no
Yeah,
names.
yeah, they're good for that. They're
you
good for
don't
that.
you don't forgot you don't spend some money on Amazon until the day before they ship it. You be like, oh,
Oh,
that's where the extra money came from.
yup.
You
That's why
know,
you should have two separate checking accounts. One where you're spending and one that's just for you. Two
no
separate
doubt.
accounts.
True, 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 true. So, as teens, young adults, they're trying to establish their credit, get things going. How does credit impact their ability to buy a home? 'Cause at some point in time, they may want to buy a house, start owning instead of renting. How does that impact their ability to purchase a home?
Um, for as far as the credit score, it limits it would affect their interest rate on the loan, what they
Okay,
qualify for in a home, which is not only affected just on the credit score, it would also be based on their income.
right.
But their credit score definitely would affect the interest rate that they would get.
Okay,
Um, and also their flexibility in the down payment, because sometimes you can make a lower down payment depending on your income and your credit score,
okay,
your purchasing power. You may be able, if your credit score was higher, you could probably qualify for 700,000 versus 600,000.
okay.
Same thing with renting. Landlords are very big on credit scores. A lot of them want good credit. Some
Yeah.
of them will identify a number and say they want, 670 or 700 credit score or higher. Some of them will just say good credit and, are not very clear about what that means.
Yeah.
Collections are a big thing. Many landlords don't want to see collections. Some are okay with it. It depends on who you're working with, but it's
Right.
going to vary from, apartment to apartment. Lenders, for the most part, are not going to want to see too many collections. Lenders are most likely are probably going to want you to pay off some collections or even pay down some of your debt. Lenders you have to meet certain debt to income ratios
Yeah.
which vary. Usually, I would say your debt to income ratio should be around 30%. But if you're
Hmm.
going like the FHA route, if you're doing down payment assistance, that number is going to vary, and it also varies state to state. So what's in New Jersey may vary depending on where someone else lives. So check with your local lender. Um, those programs have very strict requirements. Like
Yeah.
first time home buyers, I know New Jersey can get the lowest is 3.5%, but they have to meet very strict guidelines for that.
Okay.
And the minimum credit score for that, if I remember correctly, is like 580.
Okay.
Um, but their interest rate is going to be higher. They're going to have private mortgage insurance, which you can never get rid of, and that's going to raise their monthly mortgage payment.
Right.
So,
Right.
there's perks to it, but then, there's going to be offset on the other side by having the private mortgage insurance, which is going to cost you more on a monthly basis.
Okay. Okay. Now you mentioned a term that some kids may not be familiar with. You said collections. What is a collection?
A collection is when you have a debt. So whether it's a car loan, a credit card, um, any account, anything that where you borrowed money and you
Hmm.
didn't pay it, and after a period of time, depending on the lender, it could be 3 months, 6 months, 9 months, they sold the debt to a debt collector. And that's when
Okay.
it went into collections. And that debt collector will report it as a collections account on your credit report. Some debt collectors will come after you for the money and try to sue you. Some of them will just
Right.
have it reported on your account as a collections. It just depends on who the debt collector is.
Okay. And real quick, so someone, I guess, who's not familiar with what their credit score is, what are like some ways they could find out what their credit score is and where they stand?
If you bank with any major banks, a lot of
Yeah.
them will give you your free credit score within like your mobile app.
Yeah.
You can use freeannualcreditreport.com. You can get your physical credit report, not your credit score, but your credit report, which I always recommend to do. You can pull it from all three credit bureaus one time a year for free at no cost, which I always recommend to do because you want to make sure the information is accurate. I've been a victim of fraud at least 3 or 4 times.
Wow.
So definitely pull
Mm.
your credit reports, check your information, make sure your name is correct, addresses, check everything because you never know what address might have been mistakenly reported from your job, from your doctor, from whoever.
Right.
Um, Credit Karma. I don't usually suggest Credit Karma, but if you want something free, Credit Karma is a good way. The reason why is there's different ways of developing a credit score. Most credit card companies will use like Vantage credit score versus FICO score.
Okay.
But Experian, Equifax, and TransUnion, if you go on their website, you can pay for a monthly subscription and you'll
Okay.
get your actual true FICO score versus your Vantage score, which is more so used for credit cards versus like if you're doing like an auto loan or if you're trying to get a mortgage. There's the two different types of scores.
Okay. Okay. All right. So to wrap up, what advice would you give young people that's trying to, go into adulthood, get control of their credit? What would you recommend to them?
One, set a budget. Once you start working, always have a budget. Try to stick to it as much as you can. Um, be mindful and check your credit score, check your credit report. You don't have to check it every day.
Right.
Check it once a month, every few months. Like I said, credit fraud in general is very high, especially in
Right.
this day and age with technology, spam calls. Fraud can happen in the blink of an eye.
True.
So very much stay on top of your information in general. If you are going to borrow and apply for credit cards and apply for loans, make sure you're paying them on time and try to keep your outstanding balances as low as possible and just pay them back on time.
True.
Yeah, if
True.
you're going to use them, make sure. My theory has always been if I'm going to spend 100, I need to be able to have 100 to pay that back. So if I don't
Yeah.
have the money to pay it, then I don't need to spend it.
Right. You know, it's funny. I think Jay-Z said that he doesn't put anything on credit unless he could pay it off 3 times or something like that.
Correct.
Yeah.
Correct. Because if you have the cash, then you're able to pay it back. So if you want to go buy those Jordans and put it on your credit card, make sure you have the same amount in cash to be able to pay it back at the end of the month.
Right. Right. True. 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 All right. So thanks again for joining us this evening. Where can people find you if they're in the New Jersey area? They want to buy a home. How can they find you?
You can reach out to me on my Instagram, Nichole_NJ Realtor, or I operate out of Hoboken, New Jersey at Prestige Properties International. I will also send my business card. I can send it over to you. You want to repost it also, but definitely I operate, service all of North and Central Jersey and New York City. I'm
Okay.
licensed in New York also. But definitely Instagram would be the best way to reach me.
No doubt. Thank you again, Nichole, for joining us this evening
Absolutely.
and sharing your insight. I know we supposed to have done this like a while ago, but
Yes.
it took us like 10 years to get it together. So
It's
10 years later,
okay.
we're here. Right?
Anytime, anytime.
You know, but thank you so much. I appreciate it.
Yes, absolutely. Have a good one.
You as well.